It's Tuesday night and you're sitting at your desk looking at a PDF of your annual retirement statement. The number at the top looks okay. It is rising, but only slowly. The total balance is $94,612. But as you scroll through performance charts and slick illustrations of couples walking on a beach, your eye is caught by an item called administrative expenses, or maybe net management fees. It's listed at 1.2%. Sounds like a rounding off error. A dime and a few pennies of every dollar. You look at the dollar equivalent, which is approximately $1,135 for the year. You close the tab, decide the eggheads at the fund company are earning their money, and go to bed. You don't do the arithmetic. You don't see what that 1% actually costs you over a 30-year career. If you hadn't, you wouldn't have fallen asleep. By now, you will have noticed that a simple, quiet, automated extraction is about to eat almost a third of everything you will save in a working lifetime. Level 1. The illusion of the small number. The financial system was built to extract value, not to educate the consumer. The mutual fund fee structure is one of the most successful extraction mechanisms ever invented. It relies on a simple psychological trick, stating fees as a small percentage of your assets. 1.2% sounds like a small fee when you compare it to interest rates on a credit card or car loan. But you don't pay this fee just once. You pay it every year, whether the fund makes money or loses money. Even if the market drops 10%, the fund company still makes its 1.2%. They still take their cut if the market does nothing. According to the Morningstar Annual United States Fund Fee Study published in 2026, the average expense ratio for an active U.S. equity fund was 0.58%, compared to just 0.14% for a passive U.S. equity fund. Traditional wealth managers like to put you in active mutual funds that charge more than 1%, and then charge you a management fee of 1%. These fees combine to make a silent drag on your portfolio that starts working against you from day one. Level 2, the illusion of performance. The active mutual fund industry justifies these fees with better performance. The marketing brochures suggest that high-paid professionals can analyze the market, pick the best stocks, and beat a simple, low-cost index fund. But the data proves a different reality altogether. S&P Dow Jones Indices releases a regular report called the S&P Indices versus Active Scorecard, or spiva. This scorecard compares the performance of active fund managers to their respective benchmark indexes. The spiva scorecard for year-end 2025 showed that 78.78% of actively managed large-cap United States equity funds failed to outperform the S&P 500 index over a one-year period. Over a 5-year period, that underperformance rate rose to 88.96%. For a period of 10 years, it was 85.59%. That was 89.93% over that time period. And if you look out over a 20-year horizon, the data shows that about 91% of actively managed large-cap funds failed to beat the index. The figures for mid-cap and small-cap managers are just as bleak. Over a 10-year period, 84% of mid-cap active managers and 88% of small-cap active managers lagged their respective benchmark indexes. 9 times out of 10, you're paying a premium fee for a service that doesn't perform as well as a basic, automated index fund. The complexity of the active fund doesn't work in your favor. Complexity is the outcome. It's meant to make you believe that investing is too hard to do on your own. Level 3. The reverse gear of compounding. To see how a small fee can destroy your wealth, you have to understand how compound interest works backwards. When you pay a fee, you are not just surrendering the cash value of that fee today. You are losing every dollar of future growth that the fee would have generated had it been left in the market to compound. Let's look at the real math. Now imagine that you invested a lump sum of $100,000 in a broad market portfolio that earned a gross annual return of 7% for 30 years. If you paid 0% in fees, your portfolio would be $761,226. If you pay an annual fee of just 1.00%, your net annual return becomes 6%. 30 years later, your portfolio is $574,349. You lost $186,877 in value due to that 1% fee. You didn't lose just 1%. You lost 24.55%, which is almost a quarter of your potential wealth. If the fee is 1.5%, your net return is 5.5%. And your ending balance is $498,395. You lost $262,831. That's 34.53%, or more than a third of your retirement nest egg. This is mathematics, and the Center for American Progress released a report in 2014 that confirmed this reality. The report found that a 1% increase in annual fees would eat up about 28% of a typical worker's potential savings for a 35-year career. A similar scenario was modeled by the SEC's Office of Investor Education and Advocacy. On a $100,000 portfolio that returns 4% over 20 years, a 1% fee reduces the final balance by $29,000, compared to a low-cost 0.25% fee. That's a loss of 17.5% of the gross potential value. The math doesn't lie. The math says the real cost of a fee is always exponential. Level 4. The hidden fee stack. The expense ratio you see on the front page of the fund prospectus is only the tip of the extraction. Underneath, there's a pile of hidden fees that drag your returns down even further. The first hidden layer is the 12B1 fee, an annual marketing and distribution fee mutual funds charge to pay brokerages to sell the fund to you. The SEC limits 12B1 fees to 1.00% per year, and this fee is often quietly included in the expense ratio you see. The second layer is the sales load. This is a straight commission that is paid when you buy or sell shares of the fund. These loads are regulated under FINRA Rule 2341 and are legally capped at a maximum of 8.5%. But typical front-end loads for active mutual funds range between 3% and 5.75%. This means if you put $10,000 into a fund with a 5% front-end load, $500 is taken immediately, and only $9,500 actually goes to work in the market. The third layer is the hidden transaction and turnover costs. When a fund manager buys and sells securities in the portfolio, they incur brokerage commissions, bid-ask spreads, and market impact costs. In a seminal 2013 study published in the Financial Analysts Journal, Edelin, Evans, and Cadlick found that United States equity mutual funds have an average hidden transaction cost of 1.44% per year due to trading activity. This cost is not included at all in the published expense ratio. The fourth layer is cash drag. Active funds are required to keep between 2 and 5% of their assets in cash to satisfy daily redemptions from investors who sell. If the market returns 8%, and cash returns 3%, then holding 5% in cash creates an annual drag of 0.25%. And third, if you hire an advisor who charges a 1% annual advisory fee, that fee is in addition to the underlying fund expenses. With an active expense ratio of 0.58%, a transaction drag of 1.44%, and a 1% advisory fee, your all-in fee is over 2.50%. A 2.50% fee over 30 years consumes 50.80% of the potential value of a lump sum portfolio. You take all the risk, you put up all the capital, and you give away more than half the reward to the middlemen. Level 5. The tax drag and target date pitfalls. Devastating. Active mutual fund investors pay another hidden cost, especially in taxable brokerage accounts. This cost is referred to as tax drag. Active mutual fund managers are constantly trading stocks to change their portfolios, so they generate capital gains all year long. Mutual funds are required under federal tax law to pass these capital gains on to their shareholders at the end of the year. This means that as a fund shareholder, you'll be hit with a tax bill on those capital gains distributions, even if you didn't sell a single share of the mutual fund, and even if the mutual fund lost money overall during the year. This is not really a problem for passive index funds and exchange-traded funds, since they only buy and sell stocks when the underlying index changes. Therefore, they have very low turnover and almost no capital gains distributions. This tax drag can easily cost you an additional 0.5 to 1% per year in lost compounding growth in a taxable account. Also, many investors gravitate toward target date retirement funds, thinking they're a low-cost, set-it-and-forget-it solution. But target date funds are often funds of funds, meaning they buy other mutual funds run by the same company. In some cases, target date funds charge another layer of administrative fees, in addition to the expense ratios of the underlying funds. In 2021, a large fund provider changed the asset allocation of its target date funds, resulting in huge, unintended capital gains distributions for investors holding those funds in taxable accounts, resulting in tax bills in the thousands of dollars for average investors. Your tax efficiency is rarely optimized by the default setting. Level 6. The gap in investor behavior. These fees are complex, and constant marketing of active funds creates behavioral friction, which further damages investor outcomes. Each year, Dalbar Incorporated releases the Quantitative Analysis of Investor Behavior, a report that tracks the gap between index returns and the returns realized by the average investor. This difference is called the behavior gap. The 2025 dalbar report, which analyzed 30 years of historical data from 1995 through 2024, showed that the S&P 500 returned an annualized 10.20%, while the average equity investor earned just 3.50%. This is an annualized behavior gap of 6.70%. During the 20-year period of 2005 through 2024, the S&P 500 returned 10.35% annualized. The average equity investor earned 9.24%, a difference of 1.11%. In 2024, the market was up 25.02%, but the average equity investor only saw a 16.54% return, resulting in an 8.48% behavior gap. The reason for this gap is emotional decision-making. Investors see the market down, panic, loss aversion, and they sell their mutual funds at the bottom. Then they wait for the market to rebound and buy back in at higher prices, locking in permanent losses. Behavioral research tells us that losing money hurts 2.5 times more than winning it feels good. The mutual fund industry benefits from this anxiety by offering managed solutions that aim to protect you from volatility, but the fees for those solutions mean you will earn a lower long-term return than you would by simply holding a low-cost index fund through the volatility. Level 7. The conflicts of structures. The structural reality of the financial industry is that the incentives of the institutions are fundamentally misaligned with your long-term success. Brokerages, mutual fund companies, and traditional advisors make money based on assets under management and transaction volume. They have no financial incentive to recommend the cheapest, most efficient route. The most profitable product is a low-cost passive S&P 500 index fund that you buy once and never sell. But a passive index fund requires no active management and charges almost nothing, making virtually no revenue for the brokerage. That is why the industry spends billions of dollars on marketing active strategies, thematic funds, and complex advisory services. They churn out an endless stream of financial news to keep your interest, checking your portfolio and trading. J.P. Morgan's 2024 Guide to Markets showed that missing the 10 best trading days over a 20-year period cuts total returns in half, and 7 of those 10 best days came within 2 weeks of the 10 worst days. You're being exploited by the media and brokerage platforms for reacting to short-term market movements and destroying your long-term returns. They built the system to keep you active, and your activity is their revenue. Level 8. The birth of the index. To understand why we have that choice today, we need to go back in history to the creation of the first retail index fund, as well as the history of passive investing. In 1975, a guy called John Bogle founded Vanguard and created the first index mutual fund for the general public. Wall Street laughed at the notion at the time. They labeled the fund Bogle's Folly and contended that active management was the only legitimate means of building wealth. They said that it was un-American to settle for average index returns. But John Bogle knew a simple mathematical fact. The entire market is all active managers, collectively. Therefore, as a group, active managers must produce gross returns equal to the market return. But because active managers charge high fees and have trading transaction costs, their net returns to investors must, on average, be lower than the market return by exactly that amount of those expenses. Bogle found that a passive index fund, by reducing fees and trading, could generate net returns that exceeded those of the vast majority of active managers over time. And time proved him right. Today, passive index investing is widely accepted by institutional investors and academics as the most efficient way to capture the growth of the economy. The simple idea that was laughed at in 1975 is now the bedrock of the biggest retirement portfolios in the world. Level 9. The historical evidence. The mathematical power of low-cost passive investing is not hypothetical. Lives of ordinary people who built extraordinary wealth by ignoring active management and keeping costs near zero prove it. Think of Ronald Read, a Vermont gas station attendant and janitor. He was a modest man, with a low salary, modest clothes, and a used car. Yet when he died in 2014 at the age of 92, his estate was worth $8 million. He didn't do it by trading hot stocks or hiring a wealth manager. He just bought good dividend-paying stocks and held onto them for decades, letting compound interest work for him and not paying fees. Think about Earl Crawley, a parking lot attendant in Baltimore who made no more than $12 an hour for most of his career. By the time he was in his 70s, he had saved little bits of money and invested them in good, solid companies to the tune of over $500,000. Take Grace Groner, who in 1935 bought 3 shares of Abbott Laboratories for $180. All dividends were reinvested and she never sold any share. When she died in 2010 at the age of 100, those 3 shares had compounded to $7.2 million. Take, for instance, Sylvia Bloom, who was a legal secretary in New York City for more than 60 years. She made stock purchases with small amounts of her savings, copying quietly the investment decisions of the lawyer she worked for. She passed away in 2016 at the age of 96, with a fortune of more than $9 million. Take Ann Scheiber, an auditor for the Internal Revenue Service who retired in 1944 on a salary that never exceeded $4,000 a year. She invested her $5,000 savings in good stocks and reinvested every dividend. She died in 1995 at the age of 101, her portfolio worth more than $22 million. These people succeeded by avoiding the fee-heavy products that Wall Street markets to retail investors. They let time do the work, and they kept their hands off the portfolio. Level 10. The quick fix. Getting back on track financially doesn't have to involve complex trading strategies. It's about creating a simple, inexpensive system and automating it. The first step is to establish an emergency fund of 3 to 6 months of expenses in a high-yield savings account that pays 4 to 5% annual interest, which you can set up online in 20 minutes at places like SoFi or Ally. The second step is to open a Roth IRA with a low-cost brokerage such as Fidelity, Vanguard, or Schwab. In that account, you choose one index fund that tracks the S&P 500. If you are at Fidelity, you buy the Fidelity S&P 500 Index Fund, ticker symbol FXAIX. The expense ratio is just 0.015%. If you're at Vanguard, you go with the Vanguard S&P 500 ETF. The ticker symbol is VOO, with an expense ratio of 0.03%. If you are at Schwab, you choose the Schwab S&P 500 Index Fund, ticker symbol SWPPX, with an expense ratio of 0.02%. You have this fund on automatic monthly transfer from your checking account. The annual limit for Roth IRA contributions in 2026 is $7,000. That's $583 per month. Step 3 is to log into your employer 401k portal and adjust your contribution rate to capture the full employer match. This is a guaranteed 50 to 100% return on your money before any market growth happens. Once you have a match, check what the expense ratios are on the funds in your 401k. If you're in target date funds or active mutual funds with fees higher than 0.5%, look for a low-cost index fund on the plan menu and shift your money there. It's all done in less than 50 minutes, and it fixes the fee leakage that could threaten your retirement. This week, let's detail the steps for a full fee audit to make sure your progress is fully consistent with these principles. You'll log into all of the brokerage and retirement accounts you have today. You will see a page called Holdings or Portfolio Details for each account. You must find the column that says Expense Ratio or Net Advisory Fee. Search for the ticker of each fund you own and look at the fee on Morningstar or the brokerage site. If the expense ratio is greater than 0.2%, you are paying for active management that statistically is likely to underperform the index. You'll find the low-cost index fund options available in that same platform. For example, suppose you own a mutual fund that currently costs 0.8%, and the platform has a S&P 500 index fund that costs 0.02%. You will make a transaction to move out of the expensive fund and into the index fund. If this transaction takes place in a tax-sheltered account like a Roth IRA or a 401k, no capital gains taxes will be triggered. If it's in a taxable brokerage account, you may want to do the math for the potential tax liability before you sell it, and consider stopping future contributions to the expensive fund and putting all new money into the index fund. You immediately increase your net annual return by the difference in the fees by eliminating these high fees. It's like getting a guaranteed annual raise on your investments. Now you can see the board good. The fee structures, the active underperformance, the behavioral gaps, the hidden transactions are no longer invisible to you. The financial system was designed to take your labor and siphon value from it through a series of quiet, compounding percentages. But you have the math. The next step is not to trade more or find a better active manager. So the next step is to open your low-cost, automated accounts, keep your fees low, and let time pass. People who made millions on normal salaries did not have a secret formula. The simple truth they understood was that the best way to win the financial game is to stop paying the people who write the rules. To further emphasize the effect of this decision, let us re-examine another mathematical projection. Suppose you are 25 years old and decide to put $500 a month into a retirement account. So if you take that money and you invest it in a portfolio that gives you 8% gross annual return, and you pay index fund fees of 0.05%, your net return is 7.95%. By the time you turn 65, 40 years of regular contributions will have your account balance at $1,587,612. Now imagine that you make the same contributions, but this time you go with a traditional advisor who charges a 1% advisory fee and invests your money in active mutual funds with an average expense ratio of 0.85%. Your total annual fees are 1.85%, resulting in a net annual return of 6.15%. By the time you reach age 65, your account balance will increase to $947,208. The difference between the two situations is $640,404. That's quite a lot of money. It's not that you lost it because the market did not perform well. You didn't lose it by making bad investment decisions. You lost it because you let a small percentage fee compound against you for 40 years. The advisor and the fund company pocketed hundreds of thousands of dollars of your money, and your retirement nest egg was cut by 40%. This is the hidden tax of financial ignorance. The industry depends on you believing that 1 or 2% is nothing. They know most people are bad at exponential math. But you do now. You understand that for every dollar you pay in fees today, that's a dollar you can't compound for you tomorrow. You understand that passive index funds are not a compromise. They are the mathematically most efficient vehicle for building wealth over the long haul. The steps you need to take to secure your financial future are simple, practical, and well within your control. No need to track the daily ups and downs of the stock market. You don't have to read the financial news or listen to what the experts say. Just open your cheap accounts, automate your contributions, cut out your fees, and let the math of compounding interest do the work. The board is set, the rules are known, and the next move is yours. To illustrate this further, let us consider the case of Sylvia Bloom, a legal secretary in New York City for more than 60 years. Her wages were low, and she lived a quiet and unobtrusive life. She died in 2016 at the age of 96, leaving behind a fortune of over $9 million. She did not trade stocks or employ complex financial strategies like Ronald Read and Grace Groner. She just bought stock in good companies and left it there for decades, letting the dividends compound and the process get going. She sidestepped the costly funds and advisory fees that would have chipped away at her wealth. Her life is a proof that consistency, patience, and low cost are the real pillars of wealth accumulation. If a legal secretary can build a $9 million fortune on a secretary's salary, then any working professional can build financial security by following the same simple rules. The key is to start early, be consistent, and protect your portfolio from the fee leakage that drains your wealth. So just to recap, here are the 3 accounts you need to set up this week. The first is the high-interest savings account for your emergency fund, which should hold 3 to 6 months of living expenses. This account saves you from having to sell your investments in a down market should you face an unexpected expense. Importantly, if you open this account at a platform like SoFi or Ally, it is backed by the Federal Deposit Insurance Corporation, better known as the FDIC, which insures your principal against loss up to $250,000. Interest is calculated daily and paid monthly. This allows your emergency cash to build and compound over time to help offset some of the erosion of inflation. The second is the Roth IRA, where you put in after-tax dollars that grow and can be withdrawn completely tax-free in retirement. You will purchase one S&P 500 index fund such as FXAIX, VOO, or SWPPX in the Roth IRA. And third is your employer 401k. Fund that to the level to get the maximum employer match. Once you've established these accounts and automate your contributions, you're finished. You don't have to check your balances daily or adjust based on market news. Just let the system do its thing. Setup is less than an hour, but the impact lasts a lifetime. The mathematics work in your favor, the tools are in your hands, and the path to financial independence is clear.